Hi, I am Amey Abhyankar from FinQuest Institute. In this video, we'll discuss cost of capital. This is one of the modules of our certificate course on corporate finance. These are a few points which we'll discuss in this video. So firstly, understanding why do firms need capital? So there are various reasons why a firm may require capital. So a few of them may be to meet their working capital requirements. It could be for funding of long-term strategic projects. And imagine it's a bank. They will require capital for regulatory purposes. So there could be multitude of reasons why a firm may require capital. So that's why the analysis of capital becomes important from the corporate finance perspective. Now, whenever we say a firm is raising capital, that capital has an associated cost which the firm is expected to pay. Imagine a very simple example. When a retail investor approaches a retail bank and they are parking their money in time deposits. So imagine that the time deposit is offering an annual rate of 5%. So an investor investing 100 units of a currency today will receive 105 units of currency at maturity. So here we see that the investor is parking his or her money in the fixed deposit account, and for that he or she is demanding a return. So that is one of the examples of cost of funds, because the investor will not park his or her funds in a fixed deposit for free. Then it's as good as putting the money under the mattress. So any investments which we make, we are always looking at it from a returns perspective. And from when we talk of returns, the person or the organization which is raising that funds or who is using those funds are paying a certain cost on top of it. So that is what we mean by a cost of capital. So one point to remember is whenever a firm raises capital, it does not come for free. There is a certain cost associated with it, and it depends, and what the cost would be depend on the different components of capital which the firm has raised capital through. Now there is a relationship between capital budgeting and what we call as a firm's cost of capital. So capital budgeting happens to be an important area in corporate finance. So capital budgeting mainly looks at long-term projects. So let's say I am a pharmaceutical company and I wish to set up a new plant. And imagine that plant is going to generate annual cash flows. So I invest a certain amount of money today in the project, and from 1 year down the line, it will start generating cash flows for the next 5 years. So let's draw a simple timeline. So let's say here I am today, and imagine that these are time points 1, 2 through to 5. And we have a cash flow which is coming in at each of these points. Now we know that these cash flows are due at a certain point of time in the future. Now for our analysis, we want to see how much our investment is worth today. That is, we want to know how much is the present value of these cash flows. So when we say we are present valuing something, we are using the simple time value of money equation, something which we have studied earlier, which we call as FV is equal to PV into 1 plus R raised to T. So a simple time value of money equation, this will help us calculate the present values of cash flows. So if we look closely at the equation, there is a term which is given by 1 plus R, and this R will function as a discount factor. Now we need a discount factor because these cash flows are being paid at specific times in the future. So to bring these cash flows back to present, we need a certain discounting factor to be used. Now, how much should be the discounting factor? That question can be answered through understanding of WACC, or weighted average cost of capital. So for any firm, if you're analyzing a specific project which is carrying the same average risk as that of the firm, then the discount factor to be used will be the WACC number. So how do you calculate WACC? We'll see in a minute. But WACC happens to be the appropriate rate which is to be applied for discounting purposes for any project which is on average carrying the same risk as that of the firm. So once I apply WACC as a discounting factor, I will be present valuing each of these cash flows to today. So once I do that, I have a PV of all of my cash flows. And this will give me how much my investment in the project is worth. So this is how we can relate a capital budgeting project with the firm's WACC. Now, in order to arrive at the weighted average cost of capital, we need to look at the various components which the firm has used for raising capital. So popular means of raising capital is through equity and through fixed income or through debt. So each of these components will have an associated cost. So let's say my cost of common equity is KE, cost of debt is KD. Let's say the capital structure weight of my equity is WE, the weight of debt is WD, and imagine my marginal tax rate for the firm is small t. So a formula for WACC, I'll write the formula and then I'll explain what these terms mean. So the first bracket, which is KE into WE, that is taking into consideration the weighted average cost of equity which I have raised. And the second bracket, this takes care of the debt portion. So KD is my cost of debt, WD is the weight of my debt within my capital structure, and 1 minus T, this is the after-tax cost. This is because the interest expense is tax deductible. So whenever a firm raises debt, it can take the advantage of the tax shield which is provided through issuance of debt. So the first bracket relates to equity, second bracket relates to debt. So this is how we can calculate the weighted average cost of capital for a company. Now there's something called as a target capital structure. So every firm follows a certain target capital structure. So this is what we call as a long-term capital structure for a firm. So every firm will try and optimize the capital structure because an optimized capital structure will ensure that the WACC number is optimized or it is as low as possible. Because finally, WACC is the cost of funding for a company. So higher the WACC, higher would be the cost of funds for the company, and that is going to impact firm valuation. Because finally, in the end, we are interested in what value are different projects adding to the firm. So finally, the firm value as well as the investor's value has to enhance. So every firm will look at optimizing the WACC, and that stems from an appropriate target capital structure. So a firm will follow a certain capital structure which it has in mind for in the long term. However, it may so happen that whenever the firm has to raise intermediate capital, so there may be certain projects which the firm is pitching for, and for that the firm requires some bit of capital to be raised from the market. So let's say that the weight of equity to weight of debt, now this is following a proportion of 70-30, hypothetically. So imagine this is my long-term capital structure. Now, let's say the firm wishes to raise capital, so it will look out for different avenues through which it can raise capital. So imagine that though it's cheaper to raise equity at that point in time. Just imagine. So it may so happen that the weights may get disturbed in the short term and the weights may end up to be 80 and 20. So 80% of your capital structure is on the equity side and 20% on the debt side. So these are the temporary deviations which can occur in the firm's capital structure. Now this is done mainly to capitalize on the market opportunity because a firm will always try to raise capital in the cheapest cost possible. So it will try to optimize in the short and medium term. So many times financial analysts will observe that firms are deviating from their target capital structure in the short to medium term. However, in the long term, they generally go back to their long term averages. However, this kind of deviations from the target capital structure is something which an analyst has to keep in mind before he or she decides to use the WACC number in their calculations. Now let's try to understand how we calculate the cost of various components. So we look at the cost of debt first. So before we go to the methods to calculate the cost of debt, let's quickly do a recap of a few concepts around bonds. So what is a bond? So bond is any fixed income product. So one common example can be a plain vanilla bond. So a plain vanilla bond could look something like a bond which pays a coupon of, let's say, 5%. It has a tenor of 2 years, and these coupons are paid at a frequency annually, and the face value is 100. So this is what we call as a plain vanilla bond. So this bond will pay cash flows at annual time points. That is, at time point 1 and time point 2, it will pay out cash flows. Now, how much would be the cash flows can be understood through this simple equation. So these are my cash flows. So the first block is what we call as CF1. Second block is what we call as CF2. So if I focus on the numerator, I see the non-discounted cash flows. Imagine the denominator does not exist. So if I look only at the numerator, these are my non-discounted cash flows. So I have a coupon payment done at time point 1 and a final coupon payment plus the face value which gets paid at time point 2, which is my bond maturity. Now, if I add this denominator term, this is nothing but the discounting factor. So finally, in this analysis as well, I would like to know how much the bond is worth today. Because in any financial analysis which we do, we are always interested in the present value of our investment. So once I apply this discount factor, I get what we call as the present values of my cash flows. And a bond price is nothing but simply a summation of present values of different cash flows on the bond. So this is how we price a bond, and this is how a plain vanilla bond gets marked on the books of the corporate. Now coming to yields. So we have used a term small y here. So this term small y is what we call as yields. So there are common terms which you come across which we call as, say, a yield curve. So a yield curve is nothing but a simple plot of yields versus time to maturity. So from bond market perspective, yields are extremely important functions for any bond because bond price is a function of yields. So as the yields in the market move, bond prices are going to change as well. That brings us to the concept of YTM. So YTM is an acronym for yield to maturity. So the way in which YTM is interpreted is, if an investor purchases a bond and he or she stays invested in the bond right until bond maturity, and they reinvest all of their cash flows at the YTM rate, then they are going to earn a return of YTM on their bonds. And this is what we call as a bond YTM, which we commonly use in pricing of fixed income products. Now, since we have familiarized ourselves with the concept on bonds, now we can move on to methods in which we can calculate the cost of debt or cost of raising bond capital. So a popular method is what we call as a market YTM method. So when we say a market YTM method, if a firm is issuing bonds today, then what is the rate or what is the YTM at which the firms can issue the bonds? That will decide how much is the cost of debt or cost of capital for that firm, or the cost of debt capital for that firm to be precise. And this can be used as a factor in calculating the WACC number. Now, one point to remember is we should not confuse between a coupon and a YTM. So going back to our bond, the plain vanilla bond example, we had a coupon of 5%. So this was a fixed coupon of 5%. So my coupon is not changing during the life of the bond. That has been frozen in my bond prospectus. However, YTM is something which is market driven. And anything which is market driven, that is going to keep on fluctuating throughout the trading day. So always remember, YTM will not remain fixed, it will keep on fluctuating. Next is a matrix pricing method. So it can so happen that a certain firm does not have publicly traded bonds. It's a possibility. So in that case, one way to look at how should be the cost of debt would be the matrix pricing approach. And the way in which matrix pricing is applied is, imagine that the average bond maturity of the firm's bonds is let's say 10 years, and firm is carrying a rating of A plus. So as an analyst, what we can do is we can look the A plus rated curve, and on that we look at the rate for the 10 years. So whatever yield is going for the 10-year maturity, that can be used as a proxy for the cost of debt for the firm. So this is what we call as a matrix pricing approach. Now let's look at how do we calculate the cost of common equity for a firm. Before we go to the approaches, let's do a quick recap of a few key concepts on equity. So meaning of a broad market index. So a broad market index is that index which we generally call as the benchmark index for any market. So for instance, if we look at NSE in India, so that's National Stock Exchange of India. So they have their benchmark index which they call as Nifty 50. So this is a combination of 50 stocks from different sectors of the economy. So if you open up Nifty's composition, you'll have stocks from different sectors of the economy. So you have stocks from IT, banking, manufacturing, automobiles, etc. So the reason why we call it as a broad market index is because this index is composed of companies which come from different sectors of the economy. So rather than focusing on one single sector as such, we are looking at a broader market. And this is also what we call as the benchmark index. Now there's a concept of beta which is related to any common equity. So beta is a measure of risk in equity, and to be precise, that's a measure of systematic risk in a equity stock. So we say beta is a measure of sensitivity of a stock to the broad market index or to the Nifty 50 index in this example. So let's now there are ways in which you can interpret the value of beta. So let's take three values of beta. Take beta equal to 1, beta equal to 0.5, and beta is equal to 2. Now, any broad market index carries a beta of 1. So a point to be remembered, your benchmark will always have a beta of 1. And any other equities which you're trying to analyze from the beta perspective, they will be measured relative to your benchmark index. Now imagine a certain stock has a beta of 0.5. The way to interpret 0.5 is that the stock is only 50% sensitive to the market movements. So if the underlying broad market index moves by 1 unit, then that particular stock will only move by 0.5 units. Whereas consider a stock which carries a beta of 2. So that means if the broad market index moves by 1 unit, then the stock will move by 2 units. So the stock is very sensitive to the movements in the broad market index. So this is how beta numbers can be interpreted, and beta is considered as a measure of risk in equity. This is along with systematic risk, beta is also called as the market risk embedded in the equity stock. Now let's look at a few methods to calculate the cost of equity capital. First and foremost, the most popular technique is CAPM, which is Capital Asset Pricing Model. So this is the equation which we use for CAPM. So KE is my cost of equity, which I'm interested in. RFR stands for the risk-free rate. So this is the rate on government securities because government securities are assumed to be risk-free. So we look at the benchmark government security and we can use that rate as a proxy for risk-free rate. Beta is the equity specific beta. And the term in square brackets, expected return on the market minus the risk-free rate. This is what we call as a market risk premium. So a market risk premium is embedded in this calculation because whenever an investor is taking a position in an equity stock, then he or she is taking a market risk on their portfolio. So whenever they're taking a risk, they will demand a compensation for that risk. So that compensation is what we try to capture through this market risk premium. And this is how we can plug the MRP into the calculation and we calculate the cost of equity. Next is a dividend discount model approach. So this model is based on a model which we use for equity valuation. So we have P as the price of equity. D1 is the expected dividend next year. KE is the cost of equity which you are interested in calculating, and G is the growth rate. So here some bit of analyst expertise and experience comes into play because estimating the dividend next year, that is something which an analyst has to estimate, and this comes via analysts know-how of that particular industry and his or her expertise around equity valuation principles. So that's how one can estimate dividend. Then growth rate is given as a product of retention rate into ROE, which is return on equity. And retention rate is nothing but 1 minus the payout ratio. So the challenge in a dividend discount model is twofold. One is estimating the appropriate dividend which is expected to be paid out by the firm next year, and also figuring out what is the growth rate factor to be used in the calculation. So an analyst has to apply his or her judgment and knowledge for estimating both of these numbers. Once these are there, then it's simple to solve this equation for cost of equity. Third is a bond yield plus risk premium approach. So this is more of an ad hoc approach which is applied by analysts. So the way in which cost of equity is calculated is we look at the long-term bond yields and we adjust a risk premium on top of it. Now this risk premium is anywhere in the range of 2% to 5%. Now this is added on top of the long-term yield and this gives a proxy for the cost of equity for the firm. So this concludes our short video on cost of capital. In our live sessions on certificate course for corporate finance, we'll discuss more about cost of capital and related numerical examples, and also study other interesting concepts on corporate finance. Thank you.